Medicare premiums. That's what we're going to talk about here today, my friends. Medicare premiums and how they can affect you big time, and how your Medicare premiums can double, triple, even quadruple with not even a huge amount of assets. And I'm going to show that to you today because it actually ticks me off. It's one of the reasons I don't have it. I should have. One of the reasons I wrote my book on the tax bomb in your retirement plans and how the Roth IRA can help you avoid that. Because I think a lot of people are completely ignorant about how Medicare works when it comes to the premiums they pay. So I print off this sheet. This is from the Medicare, CMS, Center for Medicare Services, CMS, 2018 Medicare costs, directly from their government, not from me. And we talk about Medicare Part A, which is your free. That's your hospital insurance. Medicare Part B is what I want to talk about, though. All right. Medicare Part B, medical insurance cost. The standard Part B premium in 2008 is $134 or higher, depending on your income. However, most people get Social Security benefits, pay less than this amount, $130 on average. Social Security will tell you the exact amount you'll pay for Part B in 2008. And they give you a couple things. You pay the standard premium, and I just want to go down here. Your modified adjusted gross income as reported on your IRS from 2 years ago. So keep that in your mind, 2 years. So it's a 2-year lacking in terms of how much you pay for Medicare. If you're in one of these 5 groups, here's what you'll pay. If your yearly income in 2016, if you're filing an individual tax return is $85,000 or less, you're going to pay $134. And you can see it right there, $134. However, if your modified adjusted gross income is between $85,000 and $107,000, you're going to pay $187, which is a 20% increase. However, if your AGI, your MAGI is above 107 and below 133, you're going to pay $267. That is a doubling of your Medicare premiums. So let me explain what MAGI is and why this is so annoying. And this goes to Social Security taxation as well. Your AGI is your gross income. You got to understand the difference between your gross income and your taxable income. Completely different things. So your gross income is everything you've made before you take your deductions. That could be a standard deduction, which most likely will be now because the deductions for someone over 65 is $13,300. If you're married filing jointly, it's $26,600. So most people are taking standard deductions. The vast majority of people take the standard deductions. There's just no getting around that. Now, you might itemize, that's fine. But either way, it doesn't matter. Because when it comes to your MAGI, that all it is the amount of money you made and your tax-exempt interest. So anything you have plus tax-exempt interest goes your MAGI. Anything. So let's fast forward a few years. We're going to take Miss Smith. And she's 55 years old, and we'll just say she's single. It doesn't matter. We'll say she's single. She has $250,000 in a retirement account, 401k, and she thinks she can get 7% a year, and she's going to do that for 25 years. By the time she's 80, she's going to start drawing on this. Now, she is going to have required distributions on these accounts when she hits 70.5. Don't get me wrong. So we're just going to exclude that for the time being because on the front end, they're not very high. I mean, it's literally 3.6 the first year, 3.8 the second. And we'll even say she has a side account in which to take the RMDs. So she has $250,000, 25 years from now. If she'll be 80 years old, that's the money she expects to live on when she's retired. And she's going to get 7% a year interest. All right. She's not putting any more money in. Her value is going to be $1.56 million. $1.56 million. $1.56 million. What is the RMD for an 80-year-old lady? Let me just pause here real quick and go. 80 years old it is. Hold on just a second. 18.7. So the RMD is required minimum distribution. How much she's going to be forced to pull out of her account. So 1.356 million. Divide by 18.7 means she's going to have to take $72,000 from her account. $72,000 from her account for RMD, a required minimum distribution. All right, so let's say she's got $35,000 Social Security, so she takes the 72. You're going to be taxed 85% of that. So if she has $35,000 Social Security plus 0.85 plus the $75,000 roughly that she has for RMD, that puts her right there, 104. If she's single taxpayer and she has between 85 and 107, her Part B premiums go from 134 to 187. Now, what happens each year thereafter? Her RMDs go up because as you get older, the more the IRS wants from a tax perspective. So very quickly, in fact, I'd even say by the time she's 81, she's going to go up to the 107,000 MAGI. And at 107,000, her payments are that right there, 267. It doubled. Now remember, she's only 55 now with only 250,000 bucks. She's only getting 7% a year. We're not talking swinging for fences here. And by the time she hits 80 years old, her RMDs are alone going to make her Social Security tax 85%. And then on top of that, they're going to put her in a higher tax bracket for Medicare, where her premiums will double for sure. And then even, I mean, once she hits 133 in MAGI, it's going to triple up to 348. You think that doesn't happen to widows? I have a lady, Miss Shirley in New Jersey, and obviously I can't say who she is. And it ticks me off because the property taxes she had to pay on her condo were like $15,000 a year. And she had a home equity loan, so it wasn't being escrowed in order to pay for the property. I mean, so she had to pay for the property tax out of her own pocket. She also needed to live, and New Jersey's not cheap. So she's pulling money out of her IRAs to cover the property taxes, to cover her living expenses, to cover the payment she had on her mortgage because she couldn't afford it. And guess what happened every time she's pulling money out of her IRA? It adds into her tax bill. Guess what happens when she increases her tax bill to pull money out of her IRA to pay the property taxes? It increases her MAGI, because remember, MAGI, modified adjusted gross income, is before you have your standard deduction or your itemized deduction, and includes tax-exempt interest. It's crazy. So now Miss Shirley is easily over $107,000, and if you think she's living large in a 1,400 square foot condo in northern New Jersey, you're crazy. And now every single time she has to pull another distribution from her IRA, she's losing to the state of New Jersey, because now the state of New Jersey has a new tax law where once you break 100,000, up until 100,000, you're pretty good. But once you break 100,000, you're in the world of hurt. So now she has a new tax. Now she has to pay income taxes to Governor Christie, or I guess it's Governor Murphy up there now. On top of that, she got to pay more to the feds. On top of that, increases her taxes on her Social Security. On top of that, increases her tax bracket. And on top of that, increases her Medicare. And so now her Medicare is above 267. That's just Part D, by the way. Part B. Let's go to Part D. All right, so Part D, that's your prescription drugs. All right, so right now your premiums are basically $35 a month, roughly. Part D, if you're in the 85,000 or less MAGI, and that's for single taxpayers. I'm talking widows, individual spouses. I guess not individual spouses, divorcees, widows, or just single people. You know, it doesn't have to be a woman, be a man. But your premiums go up once you hit that 107,000 MAGI. Your premiums double there as well. And so now your MAGI being between 107,000 and 133, you're paying $33.60 more for your prescription Part D, on top of the more you're paying on your Medicare Part B. So between those, you're paying $300 a month, my friends, $300 a month for your Medicare B and D. Yeah, A is free. Okay. That doesn't stop the B and D. And this is a tragedy, because what happens is that under the new tax law, thank God, these numbers right here were not even indexed for inflation. And those numbers are brought about in the previous tax bills that we won't talk about here. But they weren't indexed for inflation. And like the AMT, the alternative minimum tax, was not indexed for inflation. Like the taxation on Social Security benefits were not indexed for inflation. That's going back to 1983, and neither were these guys right here. And if you think that it's not going to affect you because $107,000 is a lot of money, well, I would just ask you to think again, because if you're saving any kind of money into a retirement plan, a 401k, IRA, TS thrift savings plan, 403b plan, that money is going to have to come out at some point. And when it comes out, especially if you're a widow, a surviving spouse, a divorcee, or just an individual taxpayer, it's going to come out with a significant tax burden to you from an income tax as well as your Medicare Part B premiums. It's bad. It's bad. So a couple of things you need to do. You need to start saying, what do I do about this? Because what happens here, my friends, is again, it's 2 years backdated. So the actions you do today is going to affect what happens a year from 2 years from now. So it's 2018. It's going to affect what happens in 2020. So if you're 2018 and you're in a pretty low tax bracket, and for whatever reason, maybe you're in the tax golden years, which is ages 62 to 70, man, if you're in those times, that is the time right now to really start doing some tax planning. I'm telling you right now, if you're married, filing jointly, and you're the ages of 62 to 70, you are in the golden years of tax planning. Because once you hit 70, your RMD is going to kick in, and you're also going to have Social Security by that time. There's nothing you can really do about that. I mean, you can still do some tax planning for sure, but right now is when you want to start doing it before your RMDs kick in. So that way, once you start getting on Medicare, it doesn't come and swamp you because of the premiums that you have to pay, the increases. And this is, I mean, we're talking for the rest of your life. And we're talking, they can be adjusted any way they want. So we're talking huge amounts of premiums that you're probably not expecting. That's the wrong answer. So do your work right there. You can see this is not me just yapping here. It's from the Center for Medicare and Medicaid Services. That's what it is. I'll put the link in the show notes. It's dastardly. Hope this helps. If you like what you see here at Heritage Wealth Planning, please hit the subscribe button down below. Don't forget to hit the notification bell up there to be notified for future content. Yeah, this doesn't make me happy. This actually ticks me off because I've seen this happen to people. And the more they have to take from IRAs, the more they actually get swamped from various other tax issues that they were not expecting whatsoever. And it's just wrong. It's just wrong. I don't like it because at that point, there's nothing to do. And what are you going to do? An 82-year-old woman, you know, that's all the money she's got is an IRA, and she has to get it, or else she's going to lose her house because the governor or whatever the county is going to put a lien on her house. You got to pay the property tax. What you can do? Nothing. Try to sell a condo. Yeah, try to sell a condo in a high with a lot of condos on the market. See what you can get for that. That's not a pleasant sight. All right. Well, I hope this helps. Not to discourage you, but you got to do proactive tax planning. I'm telling you right now, proactive tax planning is key. So don't forget to put comments in the below. Show notes, comments, please. Thumbs up are always helpful as well. Share this episode with other people who might be interested, and we'll see you next time on Heritage Wealth Planning. Thanks, guys.